Hey, everybody. Welcome to my podcast, The Real Estate Strategies. So, what I wanted to do today is go over some of the questions that we're getting. We get a lot of really, really good questions from a lot of different venues, from TikTok, from Facebook, from our newsletter, from Instagram, from YouTube. So, it's really great. So, thank you guys for one, listening, and two, for sending in your questions, because we really do look at them, and we really, really do have a team of taking a look at these and deciding, what should we do a topic on it. And it's very, very nice to actually do content for you and not just what I think you might want. So the first thing is this is Sam from TikTok, and Sam asks, why don't you like flipping houses for cash flow? Now, this is a great one, because the first thing I thought of when I saw this the other day was, those shows that you see, like, guys online, on the, on some of the networks, there's the flipping guys, they're flipping houses and remodeling and stuff like that. So I'll tell you, it makes for a good story, but I don't believe that flipping houses takes a lot of experience. It doesn't take a lot of, ingenuity, really. It's basically you find a house and find a contractor and find the money, and then you sell it. And the problem that I have with flipping is I'm a cash flow guy, and flipping is more of a capital gain strategy. So it's a big difference. And so what I try to teach is passive income over a long period of time. And so what I do want Sam to know that I've done this. I've flipped. I've done entire condo conversions. We did a couple thousand of them. And what happened for me back in the early 2000s is we did a whole bunch of conversions. We took apartment buildings and we sold them. We broke them into condominiums and we sold them off one by one. And at one time we were selling 50 a month. It was crazy, and 50 a month at $200,000 to $300,000, even some of them $400,000 each. So we were killing it, but it was basically one big flip. So when all the dust settled, what I found is that we had made a bunch of money, but I had paid a lot of tax. And if you really looked at the fees inside of all those, then you would have seen that there were a lot. There were realtor commissions, and there were all these kinds of fees with loans and all the stuff that had happened. And so, the net, it obviously was nice. And we did well. Don't get me wrong. We made a lot of money. But the biggest disappointment for me personally was that I didn't have any real estate. I was done, so like when you flip something, when you find something, it's hard. First of all, it's really hard to find a deal. Secondly, when you flip it and you make a little bit of money, you have to find another deal. So, and that could be a problem depending on what the market's doing. So for me, I always felt like after that, we were done doing those condo conversions back in around 2006, 2007. We hit the market perfectly. But I always wondered, what would happen if we still owned those buildings and they were cash flowing today? Because they were nice properties. One of them was brand new in Las Vegas. It was a 376 unit building that only 50 units were rented at the time. So, these were brand new properties, some of them. And we sold them, all individually, one by one by one by one. And we made a lot of money, but we paid a lot in tax. And so now, come 2008, which you guys know the market wasn't great, we had to do it all over again, and so that, and I still had properties that we kept and we still had cash flowers. But my whole goal here the whole time, Sam, is to have passive income. My goal is not to work, actually. If you have $5,000 a month of expenses, my goal is to create $5,000 a month of passive income. And so it's really a short-term versus long-term strategy and what it is you want to do. So if you're young and have a lot of energy and a lot of time, go for it. But I will tell you, long-term, you're better off to have cash flowers versus a capital gain strategy. So thank you for that great question. That was awesome. And then the next question was from Mary from Facebook. And she asks a question, why do you only take accredited investors? So this is an interesting question and a good one. So my biggest issue is with people that are investing their life savings is that I would feel horrible if I lost that money for them. That's actually my biggest issue, and it's my issue. So the accredited investors, for those of you who don't know, is an actual designation that's set up by the SEC or Security Exchange Commission. And, there's all kinds of benchmarks that you have to hit in order to be accredited. And then Mary, so what happens is a guy like me who's raising money, or you or anybody, has to make a decision. Do you want to take money from accrediteds or not? And if you do not, you actually fall into a different category. I'm in a category called Regulation D. And so for us, our offerings are what are called Reg D. And so we have to collect money from accredited investors. Now, you guys have seen a lot of these startups and internet people raising money. You could put 500 or 1,000 or 5,000. They're not Reg D offerings. And so for us, we've chosen to go take money only from accrediteds through these Reg D offerings, because the compliance and all the things that are necessary to take money from people that are not accredited is a lot more. And in my opinion, there's a lot more risk, as somebody who takes that money. But also, at the end of the day, just going back to what I originally discussed, like my mom right now, she's not accredited. And so one of my biggest fears is that somebody's going to take her life savings for some reason and invest it. And, so I could easily see people doing that. And there are people that prey on the elderly and people that, they don't really care. They just try to get whatever money they can get from people. And so for me, I sleep better at night raising money from accredited investors, knowing that I could lose their money. And, I've invested in properties that have not worked out. And not very many. The last one was back in 2005. But regardless, I lost $2 million in one deal and about 10 people's money and $500,000 of my own. And so I know what it's like to lose money on a real estate deal. And I know what it's like to get on the phone with an investor and tell them. And the last thing that I would ever want to be in a position to do is call up somebody and tell them that I just lost their life savings. And so for me, that's my biggest issue when it comes to accredited is as much as I hated to get on the phone and tell all my investors in that deal where I lost money, they all had other deals and they all had big income and they all had companies and they all were okay with it because, it wasn't significant to them, even though it was significant to me. And that conversation went very well. It'd be very, very different if I lost somebody's life savings. And so that's why I stick with the accredited route. I think it's a very, very good question, Mary. So thank you. Monica, this is another one from my newsletter, and I like this question. It's, if I lower my rent on one of my units in my fourplex, do I need to lower everyone else's rent too when their lease is up and they go to renew? So I love this question. So I'm going to go into a lot of detail on it. First of all, the quick answer is no. You can rent whatever you want. So you can have rents in your unit at $1,000, $1,500, $2,000, and you can rent to your brother, sister, mother, whatever you want for half or for zero. I mean, it's totally up to you. There's no discrimination around that. However, I will give you a couple things to consider before lowering rent. First of all, there should be no reason in this market that you're lowering rent. So rents are growing everywhere in almost every metro market. So there must be some kind of a reason. And so oftentimes when you're looking at doing that, it's either a negotiation from your renter, or maybe there's a maintenance issue that you're compensating for, or maybe you just don't know that what the market rents are in that particular area, and you're doing it anyway. So all of those are bad ideas. And so it's interesting because we just had a conversation 2 days ago on one of our properties that we have down in Arizona. And it's a lease up, so it's brand new. And so we have, it's 202 units, and we probably have 50 different rents because, what happens is when you're doing a lease up, the one bedrooms we might have priced at $850 or $900, but now they might be at $925 just 3 or 4 months later, because what you're doing is you're constantly testing the resistance of the market. And so that there's a fine line there of, testing the resistance of the market and renting them for less than the market. And so you do need to know kind of what the market rents are. And I think that you have to know exactly what would happen if your tenant moved out. If they moved out, would their rent be at a higher number or at a lower number? And because I doubt, based the fact that you have 3 units at a higher number, that all 3 of those are above market. And I know for sure that rents are not going down. So a better strategy, in my opinion, is to add value. And so in the conversation I had 2 days ago with our asset manager that's running that property, I said, listen, I know you have about 40 people moving out in April and May, which of course puts stress on everything because you have that many vacancies coming up. The first thing that most people think of is maybe I need to reduce the rents, or maybe I need to give a concession because we have to renew 40 people. And I said, why don't we try something different? Why don't we try doing an upgrade? And so what we're doing right now is we're rolling out smart home technology. And for a lot of you guys know that the smart home technology that a lot of people have in their homes is now moving down to the apartments. So yeah, I'm talking about the Nest type thermostats, and I'm talking about, the auto, the Centron for the lights, and I'm talking about the automatic push button, combination locks for your front doors. Those are the kinds of things that are starting to make it to the apartment level. And so I said, well, why don't we just do that? Why don't we just do an upgrade? So let's say that you're, lowering this rent, back to your question of $100 a month, for example. The way to look at it, if it's a 12-month lease, is that's a $1,200 decision. And sometimes people just look at it as $100, but it's $1,200. And so same thing in my space, if we're doing a concession for a tenant for $40 or $50, it's really a $480 or a $500 $600 issue. So it's not a small thing. And so what I said to our asset managers, I said, why don't we just start doing these smart home technologies and give the tenants something that they don't have, and then renew them at that market or even higher. So in other words, you're adding value to the tenant instead of reducing it. So no, you do not have to lower the rent for any other reason other than, maybe you want to. But the problem that you might have, the second problem is, and I've taken over properties like this, where sometimes we'll have 80, 90, 100 units under market, and some of them $50, $75, $100 under market. And so that to me is a massive value add. So I'm looking at that going, this is awesome, because I have 80, 90, or 100 people that I can raise to market, and I might have $6,000, $7,000, $8,000, $9,000, $10,000 a month in rent lift just inside of the rent roll. And so what can happen is, as the market continues to trend up at, say, 3%, 4%, 5% a year, which is about what it's been doing, then, in 3 or 4 years, your rents can be significantly different. Just in 2 years, they could be 10% off. And so if you're already low, when that tenant starts to come to renew, you could be looking at a serious rent increase, and you'll never catch up to the market. That's when rents are rising. And so you'll never catch up. And if you decide to do that, then it could force vacancy. So what you want is that fine balance. You want to, in my opinion, if you want to not have to worry about this property and keep it 100% occupied, in my opinion, you should just stay right underneath the market rents. So you need to know what those are. And that way, if the tenant takes a look, or maybe you can even show them that, hey, this is what the rents are right now. I'm going to keep you $50, $25 under the market, and then you slowly just move your way up with the market, and that is the best way, because otherwise, sometimes you might be looking at $200, $250. I've even seen $300 rent increases. And that shocks people, and they have the tendency to move. So, great question. So the last question from Ronnie from Instagram is, I just bought a property, and I'm debating between Airbnb and a full-time tenant. This is a great question. What is your opinion on this? The Airbnb will get me almost double the rent, full-time tenant, if I rent it for 30 days at a time. So this is kind of the big elephant in the room right now. A lot of people are wondering about this issue, and there's pros and cons to both, and let me walk you through them. So the first thing is, I think you guys need to know that we have an entire corporate housing division in our company. So I have people designated to do short-term housing. So it's a thing. There are people that come, especially here. I live in Scottsdale, Arizona. Right now we have spring break and spring training, which is, we have, I think, 14 baseball teams here. And so, people that follow their Major League Baseball teams are here. It's a great time of the year. It's spring. There's a lot of golf. And so this short-term thing is significant here. And so that's the first thing to consider. If you're in the Midwest and it's cold, it's going to be a very different scenario. If you're down in Florida, it's going to be a very different scenario. If you're on the coast of California, again, very different scenario. You're going to find that the demand is there. So there's an illusion and a lure, of course, on this Airbnb or VRBO or, HomeAway or whatever it is, all these different companies out there. And there's pros and cons, and take it from somebody who's done it. Most of the time, if you can get a 30-day rental, it can be significant, and usually it has to be furnished. So there's furnishing costs. And so we had at one time almost 200 units of furniture, and we were moving them all around. We had 200 units that needed cable, TV, lights, and all that stuff, and we had lockouts, and we had all the stuff. We had people moving in. It was basically running like a virtual hotel. So it was a massive pain in the butt, trust me. Because things happen. Things break. People get locked out. They can't find the unit, et cetera, et cetera, et cetera. They don't know the parking space, and, there are all these things that can happen on these 30-day rentals. However, and it can be very profitable. So in Scottsdale, it's not unusual to have $3,000, $4,000, even $5,000 a month in the high season. But in the summer, it could be $1,000, $1,500, the same unit. So, so you do have some seasonality issues, and you do have things along that line. So for just saying, hey, should we do an Airbnb? I think you need to consider, the occupancy year round, and maybe you have. And so for that, I would say a lot of Airbnbs are not 30 days. And so some of them are weekends, some of them are 1 weeks. So if you can do consistent 30-day rentals at a really high mark, then there's some advantages. And yes, you can make a lot more money. There are some negatives. One is the people moving in and out, the wear and tear, the disruption in the place. All of those things that you would imagine. And, and who do you rent to? Do you rent to, an elderly couple that's here to play golf, or are you renting to a bunch of kids on spring break? And that's a real thing here in Arizona. You have to consider all those things, and they're very different experiences as the landlord. So, while it looks good on paper, trust me, it does. The Airbnb numbers look good on paper. They're not always necessarily good. I was in a conversation yesterday with somebody on this, and it's interesting. It was in Sun City, Arizona. Okay, so Sun City, Arizona, that you guys don't know, is age restricted. It's 55 and older. And this guy has a furnished 2-bedroom unit there, and he's thinking about selling it because the HOA is all over him. In other words, there's the people that live there are not happy that there's people moving in and out every 30 days. And so, that's a real thing. So you do have to check your CC&Rs and your bylaws and all of that, because the HOAs are all over this issue right now, and so are the cities, because the cities want tax. And so you're now competing potentially with hotel and motel tax. And so the city's tax, a resort or a hotel or something like that, and you're kind of flying under the radar. So you do have to take a look at the potential tax ramifications, the potential legal ramifications for 30 days or 60 days and less, and then also the turnover. And I will tell you, just from my experience, that our furniture in a lot of our places would only last between 2 and 3 years. And then you'd have to rebuy. And, a furniture package was, I think back then, it's around $6,000, to refurnish it, because the stuff starts getting old and kind of nasty. And so, but then you have all the other expenses along with it. So, you might have $300 or $400 worth of reoccurring expenses just to keep it open while you're trying to fill it. And sometimes you also have to pay a fee to some of these, like Airbnb or et cetera. So there's all these things to consider as you're turning it over, but it definitely looks good on paper. Now, a long-term tenant, of course, is very, very different. So, that's a set and forget deal. So the best thing that you could do, if I were you, is find a furnished rental that can rent it for 4, 5, 6 months. And you're going to get a little bit higher rent. You're not going to have the move outs. And then, you're not going to be dealing with some of that vacancy loss potentially. Another strategy, of course, is just a straight long-term renter. And if you can find that person, so I have a number of these, as you guys know, and I've had one renter for 12 years in one of my properties, and he's been paying down my mortgage the whole time, and he does all the maintenance. And so that literally is a property, I would say in the last 5 years, I've maybe been over there once. And so it's a very different scenario, So the question is, how much time do you have? Do you want to invest emotionally all the extra time to keep it full, and all the maintenance and all the management issues that can come with that, including the stuff with the HOA? So it's a fine balance. And even though it might look on paper, and it probably is, seriously profitable, it comes with a lot of other things to do. And so I think it's a very, very good question, Ronnie. Keep them coming, guys. Thank you guys very, very much for those 4 questions, and we'll talk to you soon.